Money with David Blain, a discussion about your money, including everything from investing and taxes to real estate. Now with this week's program from Blain Company in New Bern, here's David Blain.
Hello and welcome to All Things Money. I am your host, David Blain, for the next 30 minutes. We've got a great show lined up for you today. Talk a little bit about some taxes this time of year as people are rushing around. We're approaching April. In fact, many of you, when you listen to this or watch this, it'll be April already. This year you have until April the 18th to file your taxes with the IRS because the 15th is a holiday in the District of Columbia. You get an extra weekend until Monday to file your taxes. But people this year running around filing their taxes, we prepare the majority of our clients' taxes. There's a CPA firm down the road from us in the same complex that our building is in, and we see all the hustle and bustle and activity of people rushing in and trying to get their taxes done. And this time of year, I always reflect on the tax code and how it works. We see people come through our office, and we see real people paying real tax as opposed to the theoretical taxes that you hear a lot about, written about, people paying or not paying tax, how much they pay. Well, you get a very different perspective when you actually work with a bunch of real people that are paying real dollars in tax. And as I've said more than one time this year, there's 3 tax codes in America. Number 1, there's a tax code that you read about that is published, that Congress and the President talk about, that the journalists write about, and that's sort of the mainstream tax code. Then you have the other tax code for people that don't make anything, that actually get money back from the IRS for nothing. Things like the earned income credit and things like that, that they don't pay any tax, but they actually get money back at tax time for nothing. And then you have the third tax code, and this is the one that applies to the majority of my clients, the majority of our viewers and listeners out there, is the tax code for people that actually make a decent living. A lot of your deductions are phased out. You have things like the alternative minimum tax. You have a whole host of rules that apply to people that make additional money. Of course, North Carolina a couple of years ago imposed the surtax, which makes no bones about it. If you make more money, we're just going to not try to disguise it or anything. We're just going to add an additional tax onto you. So I wanted to talk a little bit today about some of these issues. There was a great article in the Wall Street Journal over the weekend about, the title of it is called "The Price of Taxing the Rich." And one of the arguments that you always hear from the different political parties on taxation is, what's fair, and, what's the people's fair share, and, either soak the rich or, have more people pay tax. And I want to kind of stay away from those type of arguments and just look at what is the reality of what's going on and what would be a smart tax policy to have. So the gist of this article is that the policy of having an extremely regressive tax structure is a very poor way to run a state. And this article focuses on the state, but it could be applied at the federal level. And I want to take this, a lot of you out there own small businesses or took business classes or have some familiarity with business. And it's the same thing. If you go into business making widgets and you have, let's say, 10 customers, and one of those customers provides 50% of your income, and that customer decides to take his business elsewhere, well, your whole business has virtually been destroyed. You've lost 50% of your income in one fell swoop. In fact, this is, I probably should have used a real example because I have a client that is an owner of a big software company in the Triangle area that about 60 to 70% of their revenue is from one company. They started very small and they got this big contract with this one big company, and they've added revenue over the years. And last year they went out and they leased a massive office space, just thousands and thousands and thousands of square feet. They redid it all, putting millions of dollars into renovating the space. And then, lo and behold, about 3 weeks ago, this client called up and said, well, what you guys do for us is really great, but we're going to do it in-house now, and we're not going to need you. But we would like to buy the technology that you've been working on. So they sat down at the table, and we're talking about some figures, and the selling company had one thing in mind, and the buying company had another, and they were nowhere close. The selling company was thinking they were going to get maybe $50 million, and the buying company was only willing to pay a couple. So needless to say, they didn't get anything, and this big client is leaving. In one fell swoop, a lot of their business has gone away. So as a business owner, that's not really a smart thing, and if you're in that position, you should be working very hard to keep that customer, but you should be working very hard on the side to develop some additional sources of revenue. Just basic good business. And it applies to anything. If you're let's say a football team or a baseball team, let's say you're a baseball team and you have one guy on the team that hits a home run every game or every time he gets to bat and produces all the runs for your team. Well, if that guy gets hurt and you've got nobody else that can play, you're going to be in trouble. So it's a basic principle across life to not be totally dependent on one particular source of success for whatever you do. And in business, it's revenue. In sports, it's producing runs or scores. And in government, it's producing tax revenue, which is what I want to get to, the bulk of this story. The price of taxing the rich. And there's a big graphic on the front of it. It talks about the top 1% of earners fill the coffers of states like California and New York during a boom and leave them starved for revenue and a bust. And when you look at the states that are having all sorts of problems, California, Connecticut, New Jersey, New York, Illinois, their state budgets and their taxation scheme was so dependent on the top 1% of people, income earners in their state, that when those people's income dropped off, they're left with these massive budget holes that they cannot fill. And so we'll get into this more next segment as we're running short unbelievably on time with our first segment here. But to rely on the top 1% of people to fill 30, 40, 50% of your state budget is just very poor management and has led to a lot of the crisis that these states now find themselves in. So when we come back from the break, we'll delve into some of the details of the states that are in trouble and the situation that caused it, and maybe hopefully some solutions. So for All Things Money, I'm your host David Blain, and we'll be right back.